On the phone, it is Dr. Ken Cyree, Dean of the School of Business Administration, the Frank Day School of Business Administration, also the Bankers Association Chair of Banking, and a Professor of Finance. Dr. Ken Cyree, good morning, sir. How are you?
Good morning, Paul. I'm doing well. How are you?
It's been a long time, hasn't it? So it's good to have you back on. Man, I'm sure the topic of conversation has changed in your environment. When you look at the overview or the scope of this, what's your initial thoughts on this? And we're talking about the SVB Bank, the collapse there, and also the Signature Bank in New York.
Well, I do think that Senator Kennedy, the clip you played just as I was coming in there, is accurate. There's a lot of stupid going on here. And, you know, I would actually expect most of my undergraduate students would not do what Silicon Valley Bank did. They really made some critical errors that were pretty basic to banking, and they were too concentrated in their loan and deposit side, which is unusual. Most of the time, for example, in a community bank that we have typically in Mississippi, you're going to have a very diverse deposit base. So you're going to have a lot of customers, a lot of small customers, mom and pop entities and things of that nature, maybe some big businesses too. But Silicon Valley Bank had a very large concentration of large depositors who were uninsured. And then I think as one public person put it, this was the first Twitter-caused bank run, and I think that was likely true because all the folks out in Silicon Valley that had money in the bank looked at things and said, we got to get our money out, and they did. And it was just like in It's a Wonderful Life, that great Christmas movie. Yeah. It was a bank run. So that's what we saw. And, you know, unfortunately, it has rippled out a little bit, at least to affect equity values. I'm not especially concerned about the banking system. I just think this was, you know, well, a good analogy for your listeners. It's like a house fire, right? Let's say you live in a neighborhood. Everybody's got 3 acres. There's a house on fire. That's really bad for that person, but likely it won't spread to the rest of the neighborhood. But if a wind comes through and starts to blow those embers, it could. But that's kind of where we are. These both that one and Signature Bank, they made some critical errors that really they shouldn't have. Is my initial take on that.
Is the takeaway from that, Dr. Cyree, that the local banks, most banks in America, are nowhere near that, and people ought to calm down because they're run a hell of a lot better? I actually saw, I think it was this morning or late yesterday, where only one member of the board or the owners or whatever had a degree in finance.
Yeah, I saw that too. I don't know if that's accurate, but yeah.
I don't either.
Most of our local banks that are community banks, and this includes even all the way up to the larger banks in our state, like Hancock Whitney or Trustmark or Renaissance or Cadence or whoever, they have a lot of banking expertise and they're paying attention. You know, this is their business. Yeah. With Silicon Valley, they had a lot of political people on there, and they were focused on kind of these shiny tech firms out in Silicon Valley, which is great until it's not. Yeah. And it turned out it was not last week, and created all the problems. So I'm not overly concerned with community banking. Now, do community banks have the opportunity to have a loss like Silicon Valley in their investment portfolio? Of course. You know, just like you and all of us, if you've got money in the stock market, you've lost a little money in the last, year or two, really. And so it creates a situation where we'll work through this with the inflationary pressures, possibility of recession, and things of that nature. But Silicon Valley Bank just really goofed up the basics of banking, and that's why we had the problem, honestly.
Well, when you hear some people saying, certainly on the right, this was a woke bank, they're not just throwing that term around. As a matter of fact, I saw another report. They had $75 million that they gave to Black Lives Matter and some other organizations like that, $75 million. But here's another thing, and I don't understand this one. Listen to this soundbite. It's real quick.
Did you just say that the Silicon Valley Bank owners took bonuses on Friday?
That is exactly true. On Friday morning, before the FDIC took over the bank, they, in fact, distributed bonuses.
In what world is that either certainly not ethical, I'm sure, but legal?
Yeah, I don't know the legality of it, but it certainly is a bad look. And a lot of them also cashed out stock the week or two before, and I do think they are in serious legal jeopardy there. I mean, I'm not a lawyer, but
yeah,
it's at a minimum, it's a very bad look. And I think people are a little tired of these elite rich people getting bailed out, and we the people seem not to get bailed out. So there needs to honestly be some settling up here with these uninsured depositors. It sounds like that won't be happening to a large degree. And I do understand that, right? You don't want other uninsured depositors to pull their money out all at the same time either across the system. So I get that. But there needs to be some payment from the folks who caused this trouble and who also expanded the trouble through some of their actions. I hope they will do that.
I'm a little confused on this one because the president, we played a clip of him yesterday saying that this is capitalism and those people who lost their money, we're not going to pay for it. But then I hear later that above and beyond the $250,000 FDIC that they will be recouping the money. So which is it? Where do those people stand now?
Well, I think there are two sides to that coin. The people that will lose their money are the equity holders, and that is capitalism. So the stockholders are going to lose their money. They're going to be wiped out. The depositors won't lose all of their money. Even in a normal bank failure, what you see is the uninsured depositors will typically get a pretty high percentage. So if you're a large shareholder above the depositor above the $250,000 threshold, you typically get 80 or 90+% of your money back. But I do think it's important that some of those guys do get a loss on the deposit side of some percentage, or else there's no reason to monitor the risk of the bank. That's what large depositors and shareholders are supposed to do, frankly, along with the regulators too. So there's a lot of failure to go around here, and I think people just weren't paying attention. And again, things are really good until they're not, and then you find out the concentrated risk on, in this case, both sides of the balance sheet, which is relatively unusual for banks, really caused the problem. So that's exactly what we're looking at, is that the shareholders will be wiped out, which is capitalism, but the depositors, it sounds like, are going to be bailed out, which, if you want to use that language, is socialism. So that's not I probably wouldn't set it up that way, but they didn't seem to call me over the last few days.
Tucker Carlson had a great program last night and had some good people on him. Maybe it was the night before last. And he was talking about all of this actually started in 2008 with some of the things that happened after the last shakeup. Low interest rates sound like a good idea, but this and that. Do we need to go back and redo the whole thing? Thank God after the Great Depression we put FDIC in here, or else we would have a big mess on our hands. But what's your thought? When did you think this started? Was it just recently, or as far as people like SVB not doing the checks and balances? Because regulators come in, don't they, normally and periodically?
Yeah, they do.
Hold on right there. Let me get back and answer, and we'll answer that question. Ask that question when we come back after this quick break. But it would seem to me that if the regulators went in and took a look at that, they could see, man, these numbers don't add up. More, and we'll ask that question to Dr. Ken Cyree when we come back right after this. Back with Dr. Ken Cyree, Dean School of Business Administration at Ole Miss. So we were talking about this. Why exactly didn't the regulators catch this?
Yeah, that's tough to know at this point without all the data. But what they were looking at, could the bank continue under normal conditions? And the answer to that was probably yes. So the way to think about this is that the bank goofed up and bought long-term securities, which is definitely their fault. And there were, the technical language is unrealized losses. So if they held those securities all the way to maturity, they get 100% of that value. But because prices had fallen, when interest rates rise, that's what happens to bonds, then they had all these unrealized losses. So it's just like you owning a stock that you bought at 20 and the stock falls to 10. Well, if you don't sell it, you're not out the $10 a share. So then they got under pressure and had to sell because of a run on the bank that we talked about earlier, where people said, I got to get my money out, which frankly is rational. And then they started selling, and I think they sold about $24 billion in securities last week, or maybe it was 2 weeks ago, and they ended up losing $1.75 billion. So that's a pretty tough situation, and that's what created the problem. So it's not fully the regulators' fault. They couldn't see that coming, but yeah, it is definitely an issue. Going into break, you asked about interest rates. There's no question that interest rates have been artificially low for a very long time. I would argue since around 2003 or 4, but certainly we've had lower rates, and what that causes is people to look for higher yields elsewhere, which means you typically take on more risk. So that's what these guys were doing too, and they got caught basically.
Do you think this is going to, anytime something like this happens and there is a big hitch in the giddy up, you have some changes out there from the perspective of just what banks do or what the federal government demands you do? What do you foresee as changes now? Because first of all, before you answer that, let me play this clip from Kevin OLeary because it kind of fits into this.
It's one of many, many banks I keep my money in. And look, I'm a big boy, and if you have more than $250,000 in any institution, you're basically a hedge fund or a savvy investor or a business. You understand your risks and you act accordingly. So I think the Fed's mandate about keeping FDIC insurance at $250 makes sense to me. But we changed all that over the weekend. We said, doesn't matter how much you have. And I understand we want to keep confidence in the banking system. What I would have preferred is to allow this bank run by idiots, and I'm sorry to say these harsh words, but it's a fact. Silicon Valley Bank is the poster boy for idiot management now. That brand is radioactive waste. And so at the end of the day, let this thing go under, because that's our democratic, capitalist system, because when you're an idiot and it goes to zero, that's okay. Most of the people that had money, including me, above $250,000 in my portfolio companies, we can take the hit. I get it. That happens sometimes. But I'll tell you what I've done since then. I've told all my CEOs and all of our portfolios, we don't want any more than 20% in any one institution, so we diversified across many institutions.
Yeah, there's an organic change there. So what do you think?
Yeah, I totally agree with that statement. It's there are not many people that are less diplomatic than me, but that's pretty harsh. But I think he's accurate. It was run by idiots. When you look at what they did, it just doesn't make any sense. So people will do exactly what he's talking about. And notice the word he used there, used diversification. That's exactly what you should do, because you don't want all your eggs in one basket. The greatest basket in the world right now. Look, Paul, you're old enough, and I am too, to remember Kmart, right? Remember Kmart was in every corner, the greatest store ever. Where are they now? So you don't put all of your money in one basket, even if it looks good at the moment. And so that's in large part what's happened. The second part of your question was what will go on in the regulatory space or elsewhere. Unfortunately, when we have crises, what tends to happen is they pass regulation to put a Band-Aid on it, which actually causes more problems often than the solution. So the best thing they could do, and I agree with Kevin OLeary there, is to let the people that had money in that bank over $250,000 absorb the loss. The shareholders are already wiped out. Make sure the large depositors get a hit too. If you don't, then all of a sudden the incentive is to not worry about it and just put your money in, because the government or the FDIC fund or whatever will bail you out. So that's not the way that it should go, in my opinion. It sounds like Kevin OLeary's on that team too.
If you go in, you want a car loan or you want a business loan or anything else, you want to buy a house, they're going to put you through the due diligence on your credit score, on collateral and everything else. You would think on some of these green deals that they finance, they would do the same thing.
Yeah, hopefully they were doing that. And, some extent, maybe they couldn't foresee the recession and the tech space. There's been a lot of layoffs in that in the recent months. So there's a chance that maybe that's what they got caught up in. We don't know that yet. But I don't think so. I think they just took too much risk on both sides of the balance sheet, which, again, is really, really rare on the liability side to have such concentrated deposit funds. Normally, in the parlance of banks, it's called core deposits. You have a very broad swath through checking accounts of individuals like, us regular people, and then not all these wealthy households. But this bank grew really, really quickly, about tenfold in the last few years, largely through funding in Silicon Valley. So these guys were putting money in the bank and then getting loans from the bank too. So it really was kind of a storm that we could have all seen coming, but they for some reason didn't seem to see it coming. Dr.
Ken Cyree, Dean of School of Business Administration at the University of Mississippi. Do you know what percentage of, and I guess it differs in different states, what percentage of the depositors are over the $250,000 in most banks, say in Mississippi?
Well, that's going to vary pretty widely bank to bank, but most of the time, the average core deposit ratio in Mississippi is generally around 60 to 70% for your smaller banks. So what you see, in other words, the inverse of that, let's say it's 70%, then only 30% of your banks would be above those levels. So generally, it's not a problem for most banks, and Silicon Valley was very unique in that regard because they were around 90%. I've seen reports up as high as 93%. I don't know exactly what's accurate, but that's very unusual.
Sure, this is a rhetorical question, but if you had many people come up and say, Dr. Cyree, you got a second here? What do you think?
Oddly enough, I've had a couple of students email me. One of them basically, they always say, we didn't think you were ever right, but turns out you were right. So I don't take much solace in that. This is basic stuff. And when you violate the basic tenets of finance and principles of finance, diversification and risk, and doing your due diligence, these bad things happen. So if you stick to your knitting and do those things, and most banks do, you're still going to have risks you cannot get rid of, like economic risk, inflation, and things like that. But if you do the right things, you can get through those without too many problems. And Silicon Valley, Signature, and all these guys, they did not do that. And then, unfortunately, the Deposit Insurance Fund is going to apparently pay them out.
I'm just guessing that there are no graduates from the School of Business at the University of Mississippi at SVB.
Not that I'm aware of. I mean, there may be some in the lower levels, but certainly not on the board. There's no question about that. I can't believe that they actually took the money and ran before the ship went down. It's just crazy that's not illegal. I'm not a lawyer, but they will probably have that clawed back, I think. At the minimum, I think when they go into bankruptcy and receivership, that'll be clawed back. I'm speculating on that, but you would think it would be. But then again, that asks a different question: wouldn't they know that they are not going to get away with it? You would think, but maybe that leads to the stupidity, or as Kevin OLeary said, the idiocy of the makeup of these people. Yeah, they probably thought they could continue on for maybe a few weeks or months, and then that would get outside of the window, I suspect. But I don't think these people, they were not rocket scientists apparently, and just a lot of mistakes, and they got caught making mistakes that ended up costing the bank pretty severely. To most of the audience, a great portion of this audience, if you have any advice for them as far as how safe their account is in the state of Mississippi? Yeah, I'm not worried about any banks in Mississippi. All of the banks have had a loss in their stock trading, if you want to use that language. Their stock price is probably a better way to say it. But that's not unusual when you have a crisis like this. In fact, we saw kind of an overreaction, and then they pop back up, most of them. So if you're bold, buy more bank stock. But if you, you might not like that for 6 months or a year, but, banks will be around, and our banks in this region are really well run by and large. I mean, certainly you can have odd things happen, but our bankers are really good, and they are paying attention to diversification risk and their due diligence. And when you do that, banking is a good business. So most of our folks are very solid, no matter where they are in the state. I've interacted with them for many, many years, and I don't have any concerns whatsoever about what we're doing in Mississippi. Great report, sir. Thank you so very much for taking the time. I appreciate it. Thank you. You got it. Dr. Ken Cyree, Dean, School of Business Administration at the Frank Day, and also Mississippi Bankers Association Chair of Banking and Professor